Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve is holding rates steady as we move through early June 2026, but the calm surface hides serious crosscurrents underneath. According to the March 18th Federal Open Market Committee minutes released by the Federal Reserve, we're looking at an 8-4 vote split among policymakers. That's not consensus. That's division. And division creates volatility and trading opportunities. Here's what matters for your positions today. Core inflation is showing persistence even as headline consumer price index numbers moderate. That divergence is critical. The Fed is stuck between officials who see a path to rate cuts later this year and those who want to hold the line. This split gives us tradable signals across multiple asset classes. Let's start with what's driving this policy tension. Energy costs are spiking. WTI and Brent crude are both pushing toward $100 per barrel, driven by geopolitical heat, particularly U.S.-Iran diplomatic friction. According to analysis from Fidelity Investments on bond market dynamics, rising energy costs could add roughly 1 percentage point to CPI. That's massive. Consumer spending represents about 70% of U.S. economic growth. So energy-driven inflation hits hard and fast. The March FOMC minutes reveal that some Fed officials still believe a rate cut is possible in 2026, but only if inflation data cooperates and the labor market softens. The majority voted to hold steady, recognizing that external shocks like energy spikes complicate everything. This isn't a Fed ready to pivot. This is a Fed waiting for permission from the data. Now let's talk Treasury markets. Despite the rate hold, yields are climbing. According to Fidelity's bond outlook, we're seeing a reset in Treasury pricing after earlier volatility. The key here is that higher starting yields improve long-term return potential for fixed income. If you've been underweight bonds, this repricing creates entry points. 10-year Treasuries are worth watching closely as the yield curve adjusts to this new reality. But here's the twist. If core inflation stays sticky and oil keeps climbing, those yields could push even higher. That would pressure equities, particularly growth names that thrive in low-rate environments. The risk-reward on duration is improving, but it's not a straight line. Equity markets are showing clear segmentation. Large-cap technology stocks are experiencing mixed performance. Some leaders are posting gains while others reverse sharply. This tells us the broad index approach is losing effectiveness. Traders need to be sector-specific and stock-specific. The indiscriminate tech rally of prior periods is over. Selectivity is the game now. The divergence in tech reflects a broader market reality. We're rotating based on rate expectations and inflation fears. Defensive sectors get a bid when inflation persists. Growth sectors pull back when long-term yields spike. This rotational dynamic creates day-to-day volatility, but also swing trading setups for those tracking sector flows. Currency markets are reflecting Fed caution. The U.S. dollar is showing firmness, which pressures risk assets globally. According to analysis from A1 Trading on monetary policy impacts, a firm dollar typically supports more conservative allocations. This dynamic is playing out in crypto markets, where the USD-crypto relationship is a critical pivot point. Bitcoin and Ethereum have experienced elevated volatility as dollar strength ebbs and flows with inflation, data releases. For crypto traders, watch the interaction between dollar strength and risk appetite. When Treasury yields spike in the dollar firms, crypto typically faces headwinds. When rate cut hopes resurface, crypto can catch a bid. It's a high beta play on monetary policy expectations right now. Let's dig into the inflation picture because this is the core catalyst. Headline CPI is moderating, but core measures are persistent. The Fed cares more about core because it strips out volatile food and energy. But here's the problem. Energy is spiking anyway, and that feeds through to broader prices. Transportation costs rise. Input costs for manufacturing climb. Services inflation stays elevated. The persistence of core inflation is what's keeping the hawkish faction of the FOMC on alert. If we get another hot CPI print or two, the conversation shifts from when to cut to whether to hike again. That's a low probability scenario right now, but it's not zero. Markets aren't pricing that tail risk adequately. Employment data is the other critical variable. Fed officials are watching for labor market softening that would justify rate cuts. We haven't seen significant deterioration yet, but the pace of job growth is being monitored closely. If unemployment ticks up and wage growth moderates, the doves on the committee get ammunition. If the labor market stays tight, the hawks hold the line. According to insights from Naveen's Fed update analysis, the central bank is forecasting a longer hold period than markets initially expected. This is classic Fed communication strategy. Manage expectations lower on rate cuts to avoid easing financial conditions prematurely. Tight financial conditions help bring down inflation. Premature easing reignites it. Here's how to position around this environment. In fixed income, the higher yield base creates opportunities in longer duration treasuries if you believe inflation will eventually cooperate. But carry protection. If oil stays elevated and core inflation persists, yields go higher before they go lower. In equities, favor sectors with pricing power and inflation resilience. Energy names benefit directly from crude strength. Utilities and consumer staples offer defensive characteristics if economic growth slows. Technology requires selectivity. Focus on cash-generative businesses with strong balance sheets that can weather higher for longer rates. For crypto, position size matters given volatility. The asset class remains highly sensitive to Fed policy shifts and dollar movements. Use tight risk management and watch for correlation breakdowns that create alpha opportunities. Oil markets deserve special attention. The approach toward $100 per barrel is a critical inflection point. If crude breaks through and holds above that psychological level, inflation expectations reset higher. That forces the Fed to stay hawkish longer and potentially derails any 2026 rate cut scenario. Conversely, if geopolitical tensions ease and oil retreats, the disinflationary narrative strengthens. According to coverage from BBC News on geopolitical factors, U.S.-Iran tensions are a primary driver of current energy volatility. This isn't a purely economic story. It's geopolitical risk manifesting in commodity markets and feeding through to monetary policy constraints. Traders need to monitor diplomatic developments alongside economic data. The vote split in March FOMC minutes is your roadmap. 8-4 means this isn't settled. Different officials see different data pointing different directions. That disagreement creates two-way risk and two-way opportunity. When the next round of inflation data drops, watch for reactions across the curve. A hot print strengthens the hawks. A cool print empowers the doves. Credit markets are also signaling caution. Spreads have widened modestly as uncertainty around the Fed path increases. High-yield credit is vulnerable if economic growth slows while rates stay elevated. Investment-grade credit offers more stability but lower returns. The risk-reward in credit has shifted toward quality over reach. Consumer spending is the wild card. 70% of GDP comes from consumption. If energy costs squeeze household budgets, spending growth slows. That feeds through to corporate earnings, particularly in discretionary sectors. Retail, restaurants, and travel could see pressure. Staples and healthcare show more resilience. Market positioning heading into summer 2026 reflects this uncertainty. Institutional flows show rotation toward defensives and quality. Retail sentiment remains mixed with pockets of speculative activity in crypto and meme stocks. But overall, risk appetite is muted compared to prior years. The Fed's challenge is clear. Navigate persistent core inflation without tipping the economy into recession. Thread the needle between too tight and too loose. The 8-4 split shows that even the experts disagree on the right path. For traders, that disagreement is the opportunity. Volatility around data releases. Sector rotation on policy signals. Curve positioning as rate expectations shift. Key levels to watch. 10-year Treasury yield moves. WTI crude at $100. S&P 500 support and resistance around major moving averages. Dollar index relative to recent ranges. Bitcoin correlation to risk assets versus dollar strength. The next several weeks are data dependent. CPI releases will move markets. Employment reports will shift rate cut probabilities. Fed speaker commentary will provide clues on internal committee dynamics. Stay nimble. This isn't an environment for large directional bets. It's an environment for tactical positioning and risk management. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.